Most retail traders think trading is about quick wins, but here's the harsh truth: 90% of them lose because they fight against smart money. Want to trade like the pros and finally stay ahead? Let's uncover why smart money always wins and how you can flip the odds in your favor. Trading isn't just about charts, indicators, or technical strategies. At its core, trading is a battle of the mind. Most retail traders enter the markets with excitement, imagining quick wins and easy profits, but they overlook the invisible forces working against them. They fail not because the market is rigged, but because their emotions and lack of proper risk strategy dictate their every move. The first trap that most traders fall into is emotional instability. Emotions like fear, greed, and hope can control decisions, often without the trader even realizing it. Imagine you've just opened a trade, and it immediately goes against you. Fear sets in. The instinctive reaction is to panic and close the trade prematurely, cutting potential profits. Or perhaps a trade starts winning and greed takes over. Instead of sticking to a plan, you hold too long, hoping for more, until the trade turns and wipes out gains. This is the classic emotional cycle that traps most traders: fear, greed, hope, and regret, looping endlessly. Humans are naturally wired to react emotionally, especially under stress. In trading, stress is constant because every tick in the market feels like a judgment on your competence. Without a disciplined approach, emotions dominate. Traders often say things like, "I just knew the market would turn," or "I can feel it now," relying on instinct rather than strategy. This reliance is a dangerous trap. Markets do not care about intuition. They respond to orders, liquidity, and patterns created by participants who operate with structure, not emotion. Another emotional trap is the desire to chase losses. Losing trades are inevitable. No trader wins every time, and pretending otherwise is dangerous. Yet, many traders fall into the trap of making back what they lost immediately. This leads to overtrading, higher leverage, and riskier positions, compounding losses instead of recovering them. The market does not reward desperation, it punishes it. Smart traders understand that losses are part of the process, and the key is to limit the damage and protect capital, not to try to win back every cent in a single trade. Then there's the fear of missing out, or FOMO, which is particularly destructive. When markets spike or crash quickly, the emotional response is almost universal: panic or impulsive entry. FOMO creates a false sense of urgency, pushing traders to enter low-probability trades. What happens next is predictable: they buy at the top or sell at the bottom, only to watch the market reverse immediately. The cycle of emotional trading repeats because there's no framework in place to manage impulses. What sets professional traders apart is that they neutralize emotions through preparation and structure. They know their strategy and stick to it, regardless of how tempting the market looks. They set rules for entry, exit, stop losses, and position size, and they execute without hesitation. By creating a system, the emotional triggers that trap retail traders, fear, greed, and FOMO, are no longer allowed to control decisions. Instead, logic, probability, and disciplined execution guide every move. This naturally brings us to the second critical factor: risk management. Even the best strategies in the world will fail if risk is mismanaged. Many traders believe they can ride it out, or go all in, for a big payoff. But this mindset is fatal. Without risk control, one single bad trade can wipe out weeks or months of gains. The principle of risk management is simple. Never risk more than you can afford to lose, and always define the maximum loss before entering a trade. Position sizing is one of the most powerful tools in risk management, yet most traders ignore it. They see a trade opportunity and bet too much, thinking the potential profit justifies the risk. In reality, overexposure magnifies emotional reactions. If the trade moves against them, fear takes over and decisions become erratic. By risking only a small, predetermined percentage of capital per trade, traders limit the emotional impact of losses and ensure they can continue trading another day. This is the principle of survivability in the markets. Without it, even a winning strategy is meaningless. Stop losses are equally important. They are not just technical tools, they are emotional shields. A stop loss removes the need to decide in the heat of the moment whether to exit a losing position. It enforces discipline and prevents emotions from dictating outcomes. Yet, many traders avoid using stop losses or set them too tight, leading to premature exits or catastrophic losses. Professionals treat stop losses as non-negotiable. They are part of the strategy, not optional. Risk management also involves understanding probability and expectation. Every trade has a chance of winning or losing. Professionals plan trades where the reward-to-risk ratio favors them over time, meaning even if they lose half of their trades, the winners more than compensate. Most retail traders ignore this principle, chasing high-risk, low-probability trades, hoping for a big win. This is gambling, not trading. The market rewards discipline and consistency, not luck. The consequences of ignoring emotional control and risk management are clear stress, burnout, and financial loss. Retail traders often blame the market for their failure, but in truth, the market is neutral. Losses are symptoms of a lack of mental and strategic preparation, not the market's intent. Every market participant, whether in stocks, Forex, or crypto, faces the same emotional and risk challenges. The difference between failure and success is how well one handles these challenges. The solution is a two-pronged approach, mastering emotions and managing risk simultaneously. Begin by creating a trading plan that outlines clear rules for entry, exit, position size, and risk per trade. Practice discipline by following the plan without deviation. Simultaneously, implement stop losses and define maximum daily, weekly, and monthly losses. Accept losses as part of the process and view them as learning opportunities, not personal failures. Over time, emotional stability and proper risk management create freedom in trading. You stop reacting impulsively to every market movement and start seeing the market objectively. Every trade becomes a decision based on logic and probability, not panic or hope. The pressure that once caused mistakes diminishes because the structure protects your capital and mindset. In conclusion, these first two elements, emotional mastery and effective risk management, are the foundation of every successful trading career. Without them, no strategy, no indicator, no market pattern can save a trader. By controlling emotions and strictly managing risk, traders move from reacting to the market to trading with confidence, clarity, and consistency. Remember, the market does not care who you are. It rewards preparation, discipline, and patience, and punishes impulsive behavior and reckless risk-taking. Understanding and applying these principles separates those who consistently lose from those who survive and thrive in the long run. Trading is often portrayed as a straightforward activity: buy low, sell high, and make money. But the reality is far more complex. Behind every market move is a subtle interplay of psychology, strategy, and influence. For most retail participants, the biggest obstacles are invisible. They stem from following the crowd blindly and trading emotionally, often as a reaction to past mistakes. Two of the most damaging habits that trap traders are succumbing to herd behavior and engaging in overtrading fueled by the desire to recover losses. Understanding these dynamics and learning to overcome them is essential for lasting success in the markets. One of the most powerful forces in trading is herd behavior. Human beings are naturally social creatures, wired to seek safety in numbers. When applied to trading, this instinct manifests as the tendency to mimic what others are doing, often without independent analysis. For instance, when a particular stock, currency pair, or cryptocurrency surges, it is common to see a wave of retail participants jumping in, hoping to ride the momentum. At first glance, it seems logical: if everyone else is making money, why shouldn't I? But the reality is the opposite. Following the crowd often leads to buying at the top or selling at the bottom, and missing the real opportunities that lie in observing market structure objectively. Markets are moved by capital, not popularity. Big participants, sometimes referred to as institutions or professional traders, don't make decisions based on what the masses are doing. Instead, they act strategically, using data, order flow, and patience to position themselves ahead of the crowd. Retail participants, in contrast, react to the same signals but too late. This reactionary behavior is why most retail trades fail. The crowd creates short-term volatility, but without a structured plan. Those caught in the wave are often left with losses when the trend reverses. One common manifestation of herd behavior is buying into hype or panic selling during fear-driven moves. When news breaks, prices fluctuate rapidly, and the majority reacts emotionally rather than logically. Retail traders often interpret these moves as opportunities to catch the trend, only to realize they have entered after the most profitable part has passed. By then, the market may reverse, leaving them trapped. This is a fundamental difference between reactive and proactive trading. Professionals anticipate the crowd's moves and act in a way that positions them on the right side of market flow. They understand that true opportunities often arise contrary to popular sentiment, in the spaces where panic and euphoria distort prices. The antidote to herd mentality is independent thinking combined with disciplined analysis. Traders must cultivate the ability to observe the market objectively, without the pressure to conform. This involves learning to interpret charts, liquidity zones, and price patterns on their own terms. It also means developing patience, because the best trades often occur when most participants are acting impulsively. By resisting the pull of the crowd, traders align themselves with market forces rather than against them, increasing their probability of success. The second habit that destroys trading performance is overtrading, often compounded by a desire for revenge after a loss. Overtrading is the act of taking too many trades too quickly without a clear edge or proper analysis. It stems from frustration, impatience, or a belief that constant action equals consistent profit. The reality is starkly different. Overtrading amplifies risk, increases emotional strain, and often results in losses that far exceed the original mistake. One of the most insidious forms of overtrading is revenge trading. After experiencing a loss, a trader may feel compelled to immediately recover the money, entering trades with higher risk or less preparation. This is fueled by the emotional desire to get even. But markets do not operate on personal feelings. Revenge trading nearly always leads to larger losses, frustration, and a breakdown of discipline. It creates a vicious cycle. The more a trader loses, the more desperate they become, and the more reckless their trades. This is a critical trap that separates successful traders from those who never achieve consistency. Overtrading also diminishes focus. Each trade carries a cognitive and emotional load. By taking too many trades in a short period, the mind becomes fatigued, analysis suffers, and errors multiply. Professionals understand this principle intuitively. They know that selectivity and quality of trades outweigh quantity. They wait for setups that meet strict criteria, understanding that missing a trade is preferable to entering one without an edge. This disciplined approach prevents burnout and protects capital over the long term. Another consequence of overtrading is the erosion of confidence. Every loss, especially one resulting from impulsive trading, chips away at the trader's belief in their strategy. This can lead to hesitation, second-guessing, and further poor decisions, a downward spiral that is difficult to escape. In contrast, taking measured trades with a well-defined strategy fosters confidence. Each successful execution reinforces discipline and strengthens the trader's ability to stick to their plan in future opportunities. Breaking free from overtrading and revenge-driven behavior requires a structured approach. First, define clear trading criteria. What conditions must be met before entering a trade? What is the acceptable risk? And what is the expected reward? Second, impose strict limits on the number of trades per day or per week. Third, maintain a journal to track not only outcomes but emotional responses and reasons for entry or exit. This reflective practice allows traders to identify patterns of impulsive behavior and correct them over time. It is also vital to cultivate a mindset of patience and long-term perspective. Success in trading is not measured by how frequently one trades, but by the consistency and quality of decisions. Profitable trades are often spaced out, and losses are part of the process. Accepting this reality reduces the temptation to chase trades or attempt to recover losses emotionally. Over time, disciplined trading becomes second nature, and the destructive cycle of herd-driven decisions and overtrading is replaced with strategic, confident market engagement. The lessons from these habits are clear: reacting to the crowd and trading emotionally destroys capital and confidence. Traders who learn to observe the market independently, wait for high-probability setups, and avoid revenge-driven trades position themselves to succeed in any market condition. Every market has volatility and unpredictability, but by controlling the impulses that lead to herd behavior and overtrading, traders gain an edge that is both measurable and sustainable. In conclusion, these two behavioral traps, following the crowd and overtrading after losses, are among the most powerful factors that separate consistently losing traders from those who survive and thrive. By cultivating independent analysis, patience, and strategic selectivity, traders align themselves with market forces rather than against them. This alignment creates clarity, reduces emotional strain, and enhances the probability of profitable outcomes over time. Success is not about predicting every market move or reacting to every headline. It is about discipline, structure, and self-control. By understanding the subtle dynamics of market psychology, traders can rise above common pitfalls, develop confidence, and build a foundation for sustainable growth. Herd mentality and overtrading are challenges every trader faces, but mastery of these behaviors transforms them from liabilities into powerful lessons that strengthen trading performance. Trading is often portrayed as a game of speed, intuition, and luck. Many aspiring traders believe that success comes from reacting quickly to every price movement or capitalizing on every small opportunity. But the reality is far different. Markets reward those who act with patience, discipline, and a deep understanding of the forces at play behind every move. Two qualities consistently separate successful traders from those who struggle: the ability to wait for the right opportunity and the ability to see beyond surface-level price action to understand the underlying forces shaping the market. The first of these qualities is patience, a trait that is surprisingly rare among traders. Patience is not simply waiting. It is the ability to wait for the perfect alignment of conditions without succumbing to the urge to act prematurely. Many traders jump into trades too early because they fear missing out, they misunderstand the signals, or they let short-term market movements dictate their decisions. This impulsive behavior often results in entering positions with poor risk-reward ratios or low probability setups. Patience in trading is about understanding that not every market movement is an opportunity. The best traders are selective. They wait for setups that meet strict criteria: entry levels, trend confirmation, liquidity alignment, and risk-reward thresholds. By being patient, they allow the market to present the most favorable conditions, rather than forcing trades where the odds are stacked against them. This selectivity increases the probability of success and reduces the emotional toll of frequent losses. Closely tied to patience is discipline. Discipline is the ability to follow a well-defined plan, regardless of the market's emotional pull or the temptation of potential profits. Without discipline, patience is meaningless because even a patient trader may abandon their strategy under pressure. Discipline manifests in several ways: adhering to entry and exit rules, sticking to risk management protocols, and avoiding impulsive deviations from the plan. It is the bridge that converts patient observation into profitable action. Many traders fail because they know the rules but cannot follow them consistently. They may have studied charts, understood strategies, and designed risk management plans, but in the heat of the moment, emotions override logic. Discipline ensures that strategy trumps emotion. It turns plans into action, mistakes into learning experiences, and potential trades into consistent, calculated opportunities. Over time, patience and discipline become habits that define trading success. Patience and discipline are not abstract ideals, they are practical tools. They prevent traders from overtrading, revenge trading, or chasing trades without an edge. They allow traders to manage losses effectively, take profits strategically, and maintain a long-term perspective that is essential for sustainable success. The ability to wait and act according to a plan transforms trading from a stressful guessing game into a structured, probability-driven process. The second critical element is awareness of market manipulation. Many retail participants fail to recognize that markets are not neutral arenas where all participants have equal influence. Large participants, sometimes referred to as institutions, professional traders, or smart money, control significant portions of market liquidity. Their actions can create price movements that appear random to the untrained eye, but are often deliberate and strategic. Retail traders who lack awareness of these forces can be easily trapped by misleading price action. Market manipulation is not a conspiracy. It is simply a reflection of the power imbalance in liquidity and capital. Large participants move markets to create liquidity for their trades, shake out weak positions, or generate favorable entry and exit conditions. Retail traders who trade without understanding this can fall victim to false breakouts, stop hunts, and sudden reversals. Recognizing these patterns requires observation, study, and an understanding of where large participants are likely to operate. One common example is the false breakout. Retail traders often see a price level being breached and assume a trend is forming. Many enter positions expecting a sustained move, only to see the price reverse sharply after stops are triggered. This reversal is often the result of larger participants exploiting liquidity levels to create favorable conditions for their own positions. Awareness of these dynamics allows traders to avoid being run over by the market and instead position themselves on the right side of the move. Another example is liquidity hunting. Large participants often push the market to trigger stop-loss orders, which allows them to accumulate or distribute positions at better prices. Retail traders unaware of this can unknowingly place themselves in the path of these movements, suffering losses that appear inexplicable without the context of market structure. Understanding that these movements are deliberate, rather than random, transforms the way one interprets charts and price action. Developing market awareness requires a combination of observation, education, and practice. Traders must learn to read order flow, liquidity zones, and market structure, rather than relying solely on indicators or price patterns. By understanding where and why large participants operate, traders can avoid traps, anticipate movements, and increase the probability of successful trades. Awareness is the lens through which patience and discipline are applied effectively. Without it, even the most patient and disciplined trader can fall into costly mistakes. Integrating patience, discipline, and market awareness creates a powerful foundation for trading success. Patience allows traders to wait for the right opportunity. Discipline ensures that they follow through without emotional interference, and market awareness provides the insight needed to avoid traps and align with larger market forces. Together, these qualities transform trading from a reactive, stressful activity into a structured, intelligent process. Consider this analogy. Trading is like navigating a river with strong currents. Patience is knowing when to wait for calmer waters. Discipline is steering your boat consistently along a safe course, and market awareness is reading the currents to avoid hidden obstacles. Without any of these three, the journey becomes treacherous, and losses are inevitable. With all three, progress is steady, deliberate, and directed toward long-term success. Trading is often portrayed as a game of intuition. Many aspiring participants believe that success comes from following gut feelings, hunches, or sudden flashes of insight. The reality, however, is far more structured. The most successful traders do not rely on instinct, they rely on discipline, consistency, and a mindset attuned to probability and risk management. Understanding this fundamental distinction is essential for anyone seeking to survive and thrive in the markets. Two critical pillars distinguish successful traders: the ability to prioritize discipline over instinct and the capacity to cultivate a mindset aligned with long-term success. The first pillar is discipline. Discipline is the ability to execute a pre-defined plan consistently, without being swayed by fear, greed, or external noise. While instinct may sometimes align with profitable outcomes, relying on it is inconsistent and dangerous. Markets are unpredictable, and human emotions are volatile. Instinct is reactive, discipline is proactive. Instinct reacts to fear, market hype, or recent losses. Discipline enforces a structured approach, ensuring that every trade meets established criteria, every stop-loss is respected, and every position aligns with risk management principles. Consider the difference between two traders. One follows instinct, entering trades based on a feeling or rumor. The other follows a well-defined strategy, patiently waiting for setups that meet strict conditions. The instinct-driven trader may experience occasional wins, but these are often fleeting and unsustainable. Losses are likely to be larger because decisions are made emotionally, without a framework for evaluating risk or probability. The disciplined trader, on the other hand, may win less frequently in the short term, but over time, consistency compounds into significant gains. Discipline transforms trading from a guessing game into a probability-based system. A core element of discipline is adherence to rules. Rules are not arbitrary, they exist to protect capital, minimize emotional interference, and optimize long-term profitability. Examples include determining entry and exit points before the trade, limiting risk per trade to a small percentage of capital, avoiding trades outside the defined strategy, and respecting market structure. Professionals treat these rules as non-negotiable. They understand that short-term emotional impulses can never outperform the long-term advantage gained from following a consistent, rule-based approach. Discipline also includes managing emotional responses. Fear, greed, and overconfidence are powerful forces that drive instinctive trading. Even the most experienced participants can fall prey to these emotions. By cultivating discipline, traders create a buffer against impulses. They learn to act based on data, probability, and planning rather than reacting to market noise. Over time, discipline becomes habitual. It replaces instinctive reactions with calculated actions, creating a sustainable edge in the markets. The second pillar is mindset, the internal framework through which traders interpret market outcomes. A powerful mindset is not about blind optimism or relentless confidence. It is about understanding probability, embracing risk as part of the process, and prioritizing capital preservation. Many participants enter the markets with a fixed expectation. They want to win every trade or never experience a loss. This mindset is incompatible with the realities of trading. Losses are inevitable, but the difference lies in how one perceives them. A strong mindset allows traders to view each trade objectively, regardless of the outcome. Losing trades are not personal failures, they are data points and learning opportunities. Profitable trades are not celebrated with overconfidence. They are evaluated within the context of a long-term strategy. By shifting perspective in this way, traders eliminate emotional turbulence and create mental clarity, a state essential for consistent, rational decision-making. One of the most dangerous mindset traps is ego-driven trading. Ego encourages revenge trading after losses, chasing trades after a missed opportunity, or over-leveraging in an attempt to prove skill. Ego clouds judgment, overrides discipline, and blinds traders to the objective reality of market probabilities. Cultivating the right mindset involves letting go of ego, embracing humility, and focusing on process rather than immediate results. This shift enables traders to execute plans effectively and remain resilient under pressure. Another key aspect of mindset is long-term perspective. The market does not reward short-term heroics or impulsive brilliance. Success is measured over months and years, not individual trades. Traders with the right mindset prioritize consistency, risk management, and continuous learning over instant gratification. They understand that patience, strategic decision-making, and adherence to a structured approach yield compounding advantages over time. Short-term losses become temporary setbacks, not catastrophic failures.